As you say, there were a new set of objectives set in 2012. That was agreed by shareholders. The formal objective is for the trust to achieve a return of LIBOR plus 3%. However, the asset structure that was put in place at that time was very much, we believe, capable of producing better returns than that. And the current asset structure, we feel, is capable of producing 6% after costs in real terms.
So as Alan was saying, we are a multi-asset trust, which means we're investing across a wide range of asset classes. And the starting point for us is to try to ascertain what we think the trust is capable of achieving over the long term, which is a real return of 6%. And then we combine that with our long-term views on what each asset class should be able to produce over the long term, and come up with a strategic asset allocation. So to give you an example, in the UK equity space, we have a strategic asset allocation of 35%, overseas equities is 25%, etc. Now, in relation to that strategic asset allocation, we think we can add value through active decisions, whether that relates to tactical asset allocation or holding selection in the UK, or fund selection in overseas equities, or fixed income where we're using third-party managers. So the combination of the long-term return that you should expect to get from the strategic asset allocation, plus the value added that you should achieve, that we should achieve from our fund manager decisions, that we think is going to give the fund a return of 6% real over the long term. I mean, there is one other thing that I should mention, is that although we have these strategic asset allocation weights, we have quite a wide range for each asset class in which we're able to operate, which does give us the flexibility, say, to increase equities or decrease them if we think that's appropriate. So we are active managers, which means that we make predictions about the future, and the question, of course, is, well, what is the basis? What is the common theme for making investment decisions? And what we're now using is the term multi-asset value investing. And we know this is new and unique, because if you Google for the term multi-asset value investing, you won't find any results at all other than Seneca. It is new. It is taking a little bit of time to communicate what this means. But to put it simply, what we're trying to do is base every single one of our decisions, whether it relates to tactical asset allocation, whether it relates to the selection of a UK stock, whether it relates to a specialist asset, whether it relates to a third-party manager. We're trying to make the decision on the basis of something being cheap. So it could be a market, an equity market somewhere around the world that we think is cheap. It could be a part of the fixed income spectrum that is cheap. And in the case of third-party managers, we're looking for managers who themselves have some sort of strong value-oriented ethos. Ultimately, the principle of buying things cheaply is one that is a very simple one and makes absolute sense. You can apply it to investing. You can apply it to grocery shopping. So the idea is that if you buy something cheap, you've got a much better chance of making money.
So I think the first thing to say is that we do have, I think, a big benefit in being multi-asset managers. And I think, effectively we're fishing in a lot of different pools for income. So at the moment, whilst equities may seem a little bit expensive to some, we're particularly concentrated on mid-caps in the UK. And I think there's very solid evidence to sort of see that mid-cap companies outperform larger companies over long periods of time. And we're certainly still able to find very good value and good yields in that mid-cap universe. So that's the direct equity investments in the UK. We also have, I think, another sort of interesting factor to what we do is the specialist assets that we invest in. And really with these specialist assets, we're looking for investments that have yields that are higher than equities perhaps, but also in many cases inflation-linked dividends that make them look more attractive than bonds, and quite often with very strong asset backing. So an example of that may be our renewable energy investments, and perhaps it's quite topical at the moment with RPI and inflation perhaps looking to pick up following the fall in sterling over recent months. It's very helpful, I think, to have part of the portfolio in the specialist assets, which will give us some protection against that. So the renewable energy holdings are giving the fund exposure to both solar, wind and waste power production, and yields of 5%, which are effectively index linked. We think that's quite an attractive part of the portfolio. Other investments we have in that area would be things like aircraft leasing, high nominal yields and the potential for significant returns from a portfolio of aircraft that are leased to different airlines. These are long-term leasings that have been undertaken by the quoted vehicles in which we've invested, and running yields of 7.5% and some potential for capital returns from here. So again, a slightly different aspect to just investing just in equities and bonds.
So with respect to the two major asset classes, equities and bonds, we continue to be overweight equities, and we're underweight, very underweight fixed income, particularly safe haven bonds. Let's start with the equity position. We think that although the business cycle around the world is fairly well advanced, we still think that it has some way to run, and that should be very positive for equities. If you combine that with valuations, where we're still finding that yields are not quite as high as they were 5 years ago, but they're still pretty decent, either in line with historic averages or in some cases slightly above. So that provides us with comfort that equities still do offer good value. And the reality is that bear markets don't tend to start until valuations are actually very stretched, meaning that yields are very low. So we're not at that point yet. As far as bonds are concerned, we've had a very underweight position in safe haven bonds for some time now, and that's really been a position that has actually worked against us. 3 years ago we felt that safe haven bonds were expensive on very low yields. The reality is that over the last 3 years they've become even more expensive, to the point where in the UK you've got long-term real interest rates of close to -2%, which means if you buy these things and hold them to maturity, you're going to lose a lot of money. So we're very comfortable with that underweight position. That's not to say we're not finding some value in bond markets. We think there's still some good value to be found in emerging market bonds. We think there's still good value to be found within the short duration high yield space. So we're not completely out of fixed income. And then the third area is specialist assets, where, as Alan was saying earlier, we're finding some really interesting yield opportunities. And a lot of the time these investments, they have performed better than the broad equity market. Volatility has been lower than the broad equity market, and also correlation of these investments has been quite low, and in a couple of cases actually negative. So by adding these investments to a portfolio, they really help to enhance the risk return profile. So what we really like to think we're doing is that we're presenting a trust that is a lot more interesting than a traditional balanced fund. That's what the specialist assets help us to do. But we're not doing really complicated things. You know, an investor should be able to look at our trust and understand what we're doing there. We're avoiding complex investments such as structured products or hedge funds or derivatives or some of the more esoteric asset classes like forestry or art or wine. What we're doing is really fairly simple. I mean, if I may just touch on one final thing, think of the really three important exposures that we have, or positions that we have, as being no safe haven bonds. That we think is very justifiable given the valuations. We have this focus on mid-caps in the UK, which we think is another area where we can get higher returns than large caps. And then the third area, which is very important for people who are either nearing retirement or who are in retirement, is that the trust actually has fairly low foreign currency exposure. And we think that's important because a lot of the time foreign currency exposure can actually add a lot in the way of risk, but doesn't tend to add very much in the way of return. So having a relatively low exposure to foreign currencies is another thing that, you know, we think investors are and should be looking for.
Yes, there's been a period of 3 or 4 years in which we've been gradually managing to improve the valuation of the fund, and I think it was important, and the board felt it was important, that that was effectively locked in. So we've moved from a position of being on a sort of 12, 13 discount 3 or 4 years ago to a position where the trust was trading on, you know, somewhere around net asset value for a little while. And I think it was felt important that we should, for new investors, look to lock that in. So a discount control mechanism was introduced by the board in August of this year, and that effectively means that the trust will both be a buyer and seller of shares somewhere either side of net asset value, but quite closely sort of linked to the net asset value. So new investors can know that there'll be liquidity in the shares if they want to buy, provided by the company itself. Also, if they want to sell, they'll be able to sell shares back to the company at a very small discount to net asset value, therefore taking to some degree the risk of the shares trading on a very large discount at some point in the future. And we believe that leaves the trust well positioned to grow over time, but also I think provides that additional layer of sort of liquidity for investors, which sometimes can be absent in investment trusts.